Hello and welcome back to Bunnex Investment Group. In this video, I'm going to give you a win less and more strategy. I love this particular strategy because it is the secret in trading, the golden ticket that you are looking for, your ticket to the financial freedom that you are looking for, if I can say the holy grail of trading. Right, so winning is not about pips. I hear a lot of traders come, how many pips do you get, or what is the maximum number of pips that you get? It's not about pips. It's also not about win rate, but it's something the professionals use, and now you will too. I'll actually teach you how you are going to trade as a professional. Because of course we can talk of all the strategies, but if you do not know what I am going to impart to you in this particular video, it's better you quit trading. All right, so what if I told you you could lose more trades than you win and still grow your account? So in this particular instance, we are saying no more chasing 100 plus pips, no more stressing over being right every time, just one metric, the ARA multiple. A lot of traders doesn't understand this concept, and it is the basic foundation to consistent profitability. If you do not understand this one metric, you are basically trying here and there, or actually getting wins out of luck and so forth. So what we want to do is to basically change you how you view the markets, how you are going to approach the markets, and actually see this business as a money printing machine if you understand these concepts. So most traders actually measure the wrong things. A lot of traders chase pips. They want to hear thousands of pips per month. They also obsess over win rate. What is the win rate? They only want to hear of 90% accuracy and so forth. They also panic after a few losses, but do not understand that losses are actually part of the system, and they are actually required for the system to actually work out. So the professionals think in ARA multiples, and they know exactly how they turn, how much they risk, and how much they can make in return. So if you understand this particular concept that I'm about to show you, you are going to see a dramatic change, reduction of stress in your trading, as well as confidence with trading as a sustainable source of income. All right, so here is what you are going to learn. I'm going to dive deep on what an ARA multiple is, why pip counting and win rate don't matter, how to become profitable with probably just 4 wins out of 10, and a formula that can even grow small accounts. So in this particular instance, we want to turn trading to be something that is sustainable for you and your family, something that you can rely on, something that can allow you to even quit your job after understanding and being able to execute everything that I am going to show you. All right, so basically what is an ARA multiple? I'm sure you've seen me talking about ARAs, whereby I say we've lost 1R, we've lost 1R or 2R. So an ARA multiple is a simple way to measure the performance of a trade relative to the risk, the amount of risk you take. It is basically the amount that is going to be consistent over a series number of trades, so that you can actually see the performance of your trading. So it might be a difficult definition there, but let me try to illustrate. We say 1R, right? If I'm saying 1R, I am referring to the amount you risk on a trade. So if you risk $50 to make $100, that's plus 2R that you'd have made. If you lose $50, that's minus 1R. So what you are supposed to be consistent about is to have a consistent R. If you say I am going to have a $50 as my R, or as my amount to risk on your trade, you are supposed to consistently expose your account to only that amount. So it standardizes your results no matter the asset or pip count. So where are we coming from when we say pip count is not necessary? If you have a winner on gold, you might actually say, I won 2,000 pips. If you have a winner on CHF JPY, you might say, I won 80 pips. And if you lose on gold, you might say I have lost 1,000 pips. And if you lose on CHFJPY, you might say I have lost 30 pips. If you actually find the algebraic sum of all those values, you'd find yourself being in an ultimate loss if we are talking about pips. So the ARA multiple will actually allow us to be profitable even with a win rate of 50% and below. If you as long as your average R is high enough, right? So this explanation might be difficult. Let's try to break it down so that it will be simpler for someone. All right, so I'm going to show you how to be consistent in trading, right? Firstly, professionals think in percentages. When you have your account, you've deposited $100. I'm sure that is the amount that is within the reach of many. $100, $500, $1,000. What is your risk per trade? You have to write it down, and that is where consistency will start. Say we have $500. So we are saying on your $500, what is the percentage you are willing to lose per trade and remain sane? Because if you risk big, you are definitely going to panic. You're definitely going to throw away your trading plan and so forth. So we need to define how much risk per trade that we are willing to lose and remain sane. So we are saying on a $500, are you willing to lose 1%? And 1% on a $500 is going to be $5. 2% is going to be $10, and 5% is going to be it's $25, and so on and so on. If you say I am a 2% risk exposure or risk trader, right? It means your R is going to be 2% for a series of trades. So when we talk of consistent risk exposure, we talk of lot sizing, right? How is that 2% going to be maintained within the markets? We are now saying when we enter Euro USD, right? The lot on Euro USD is different from gold USD, right? So for us to actually have a consistent risk. So we are saying, let's say we are taking 10%. We say this is $10, so the 2% of our $500. We should lose $10 as well if we are on gold. If we go to USD, CHF, we also need to lose $10 if we are wrong. If we go on NASDAQ, we should be able to lose $10 again if we are wrong. How does this come? It means the lot size for euro is different to the lot size for gold, and the lot size is also different due to the fact of the number of pips that are on our stop loss or the price value of our stop loss. And this is done simply by calculating a lot size for each and every trade, which when we are wrong, we will lose our predefined risk, which is equivalent to 2% of our account. So this is done to enter a trade with a lot size, which when we are wrong, we lose the predefined risk percentage of our account. And let me show you how it is done using an application that we call a Forex calculator. You need to have that if you are a professional trader. A Forex calculator for Android, and I'm sure it is also available for iPhone. After obtaining a trading signal, the next thing is now to calculate your lot size as shown here. This is the application that we are going to be using to calculate our lot size, which when we are wrong, we are going to lose our 2% on our $500 account. So this application is actually found on Google Play for Android, and I'm sure for iPhone it is available. So the first thing that we are going to do is to select the instrument that has come from our signal. In this particular case, they've been said to buy GBP CHF. Then amount to risk, you can actually put an amount to risk, but I like to use risk percentage. So in this particular case, risk percentage, we're going to say our account balance is going to be $500, and then our risk percentage, we've said is 2% of our balance, and then our stop loss in pips is going to be 30 as that has been said from the signal. After that, we hit calculate. And after calculating, we only take the standard lots, which is 0.3 here, 0.3, that is the one that we take. And then it is the trade that we are going to enter, the trade we are going to enter with 0.3, and our risk per trade is going to be $10, and then that is it. All right, so basically that is how you calculate your lot size. And for different pairs and different instruments, you only need to just change the instruments and input the new values. Account balance, you input the number of pips to your stop loss, you input, and then you get your lot size from the standard lots. So why pips don't matter? 20 pips can be 2R and 100 pips can be 0.5R. We are saying consistent reward per risk is the key. This is the illustration of what I'm trying to put across. We are saying we have this trade 1 and trade 2. Both these people entered the market, but the other one had a 40 pips stop loss and a 60 pips take profit. The other one only had 30 pips take profit and 10 pips stop loss. In terms of reward to risk, we are saying his R target was 3R, right? And this one, in terms of reward to risk, his R target was 1.5 to 1. So in this particular instance, of course, this would say I got 60 pips, right? And this one would say I got 30 pips. But who made money than the other? Trade 1 is a take profit of 30 pips, and trade 2 has a take profit of 60 pips. However, trade 1 is more profitable than trade 2 due to the fact that if we are saying our R, in this case, our R is, we've said it's $10, and here it's also $10. Meaning that if this stop loss is hit, the account is depleted by $10, and also this point, if the account is hit, it's also depleted by $10. So $10, and if we are to say with the winning part, we are saying it's 3 times what we are risking. So the winner is going to be $30. But in this particular case, the winner is going to be $15, although he had a lot of pips. So this mathematics is the mathematics that is behind consistent winning and consistent cash out of profits, not win rate or number of pips. So we are saying you can win less and still you can win less and still win big. Trade 1, you lost 1R. Trade 2, you lost 1R. Trade 3, you won 2R. And if we say this is 50% win rate out of these 10 trades, and your total is actually 5R, right? After subtracting the losses from the winners, the net profit will be 5R, meaning 5 multiplied by the risk. If our R is 2%, it's going to be 10%. 5 multiplied by 2, it's going to be 10% as our reward, or as our net profit from the sum of these losses and wins distribution. So in this particular case, we are saying at 50%. But if you hear traders, if I tell a trader that my accuracy is 50%, you would see that trader running away, because all that they want to hear is my accuracy is going to be 90%. If we reduce the accuracy, let's say this was a loss, right? If this was a loss, it was going to be minus 1R. Our accuracy is now at 40%, right? At 40%, we are saying it's 2, 4, 6, 8, right? Minus 1, 2, 3, 4, 5, 6. 8 minus 6, that is 2R. That is our reward. So 2R multiplied by 2%, which is our R, is going to be 4% of our account for these 10 trades, right? So basically, that is how you will, if we reduce to 3 out of 10, in this particular case, 3 out of 10 will actually leave us at break even, right? So 40%, 50%, if you have 55% with this particular distribution, you'd find yourself cashing out consistently. So if you allow yourself to lose 6 trades out of 10, is that going to stress you, or are you going to shift strategies after a few losses? No, because you are definitely going to remain calm. All right, so here's the formula for consistency. We are going to look for setups with at least plus 2 R potential and risk a consistent amount per trade by calculating the lot size, which allows us to lose a consistent amount when we are wrong. Move to break even after plus 1 R and let your winners run. So BTMM Pro, which is an indicator for MT4 that I developed, can actually help you to find the 2R setups. This becomes the signal generator for your side, and you will be working around with the stop loss, with the lot sizing, so that the mathematics will become consistent. So it works on M15 for precision, it shows cycle initiation points, and it is designed for plus 2R moves. You can get your copy using the link that I will leave in the description box below. Right, so here is the summary. We are saying consistency is about reward versus risk. Track your trades in R, not pips, and focus on setups that offer 2R or more. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the free Telegram channel, which I'll leave the link in the description box below.